Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Twitter. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Well, what can you say about the markets today? They're obviously tanking. The VIX index is finally up above the 30% level. I've talked about that a lot on this show, that the VIX just wasn't showing the fear and uncertainty that was really warranted in this marketplace. So I'm going to start by not necessarily going to a chart of the S&P 500 index and all the indexes, which are down, all down precipitously. So let's look at the VIX watch list. I have this up today. And the biggest thing that I wanted to note from last week is the rise in interest rates. Right now, I'm highlighting a little bit on the chart. This was from last week. This is a day chart going out 3 months in time. But we have a lot of green candles on the TNX, which is the SIBO index that tracks the interest rate of the 10-year. The interest rate, all you got to do is move the decimal point. 27.47 means it's 2.7% on the 10-year. We spent a little bit of time above the 2.9% level, but dangerously close to the 3% level. Haven't seen these levels since November of 2018. The Fed, there's been whispers that over the next 2 sessions that they may even go as much as 75 basis points, which that's what really started the spook in the marketplace. They're definitely thinking about the next 2 bumps being around a 50 basis point bump. So because of that nervousness and the fact that people are a little bit worried about, obviously, the recession, we've had the downturn. The VIX has reacted accordingly. Right now, we see the VIX index trading at 31.54. It's up $4.52 today, but it's been hanging around the 30 level for quite some time. I thought for quite a while that the VIX being down around 20%, which to me is basically normal volatility. And the way that I kind of look at the VIX, I guess I'll throw a couple of words in here about that, is let me add this to the chart. 1 second. Add to chart. There we go. If you look at the moving averages in the VIX, it's always a mean reverting index. So in this instance, the 200-day moving average, I think, is kind of where I would consider stuff to be normal volatility. You're taking the 200-day moving average as the slowest of the moving averages. And we see right now that that's right around, not even below that 20 level. It's 21.26. So the fact that we just hung out in that range for so long, right around that 21 level, before we got that spike up and recently down back around that 21 level, now we're finally back up, kind of showing some of the concerns, some of the angst in the marketplace. The VIX is really the fear index, as you maybe have heard it quoted before. It has a lot to do with, well, it's the implied volatility of the S&P 500 index options. It's a 30-day weighted average. It's never becomes a 29-day. It's always around 30 days. And the S&P 500 index is the favorite of institutional and retail traders to actually hedge portfolios, buying puts in the S&P 500 index. The more and more puts that get bought, premiums rise quicker and quicker. And when that happens, that increases the implied volatility on the VIX index. And here we have a lot of nervousness in the marketplace. Even though we're in the middle of earnings season, Netflix didn't help anything out. But this week we are in the middle of the earnings season. We have Amazon, Apple, Twitter, which is going to be interesting, and that's what we're going to talk a little bit about today. And 3M is also, well, 3M announced this morning. We have Exxon going to be announcing on Friday in the morning. So just a plethora of information that's coming into the marketplace as far as earnings. And earnings are the one thing that can pull us out of these doldrums. We've really been beaten up as far as the mega cap stocks. At some point in time, you're almost nervous, like where are they going right now? Even though they're trading at very solid valuations than they were obviously 4 or 5 months ago. So that will be, I think, the main driver of the markets is what's going to happen at the end of this week to try to get rid of the angst about if our economy is still going to continue to grow with these rising interest rates. And studies have been done in previous instances where the Fed has acted and raised interest rates in a fairly quick fashion. And the marketplace can usually handle that. And in most instances, the markets did actually go up. It's usually a good sign that we need to raise the interest rates. Now, the biggest thing is how quickly are we going to have to do it? That 3/4 point movement that's about a 20% chance of happening over either this meeting or the next meeting of the Fed. That is what I think really spooked the marketplace. Now, on top of it, obviously, we have the situation in Ukraine. Doesn't look like we're coming to any resolution anytime soon. That's driven up commodity prices, really hurt the European economy. And so with all of that combined information, we finally see the VIX up above the 30% level, trading at a high volatility. And for the first time in about 2 or 3 weeks, where we really got a good solid movement up in the VIX. Not saying that it's good. It shows that we're a little nervous, but it leads to maybe some capitulation in the marketplace. If we see the VIX continue on up, if you notice here from the chart, very rarely do we get above that 37 level. And I'm going to zoom out a little bit on it, actually. Let's see, since the pandemic, how many times we've actually breached the 40 level in the VIX. I mean, we have one here. This is back in June of 2020, came close here, November of 2020. And then we've never really seen those levels yet. So when the VIX is raising, it has risen enough to get up towards that 40 level. A lot of times that's a sign of maybe we can get some capitulation in the marketplace, and maybe we can get the marketplace to go the other direction. I heard somebody quote the other day, and I thought it was a real interesting quote. They said the market should go up, but they're just not. We have still low unemployment rates. The biggest thing here, I think, are the unknowns that are happening in Europe. Until we get some resolution on that, I think with the conflict, I don't think that the markets can really make any real move to the upside, but we'll see. So let's talk about the one thing that everybody is talking about, and that's Twitter. Elon Musk decided that he wanted to buy Twitter, and he made a joke of it, of course, as usual. He said that he would like to buy the stock out at $54.20, and for some reason that 420 is one of his favorite numbers. Twitter might be able to actually get a higher bid if they can convince all the cannabisers to come on out and maybe change their favorite holiday to 9/20. Who knows? Maybe Elon would raise his bid. But at this point in time, there's really no other suitors, nobody interested at that $54.20. And guess what? We got that news this week, and Twitter's going to be announcing earnings on Thursday before the open. So our title of today's event is that we're going to fly away with Twitter. We're going to do a butterfly. This is going to be the most advanced trade that we've ever done on the stock play of the day. So with that said, nothing's meant to be a recommendation. This is going to be a real speculative trade. And what's really fun is that we're going to come back on Friday for the stock play of the day overtime, and we're going to be able to know what happened with Twitter and with this trade. So the trade that we're going to look at, and I'm going to run over to the options playbook. And that trade is actually called a Christmas tree butterfly. And we're showing it here in the options playbook. So we got to get a little bit fancy because the pricing of the options, obviously everybody knows the 54.20 level is a very important level in Twitter. I think personally that I would have just waited till the earnings announcement to try to negotiate this deal, but that's Elon Musk does what Elon Musk wants to do. But with that mentioned, that is a stopping point until we still got to figure there's still a ton of unknowns. where is Elon going to get the financing? Is there anybody else? Is he going to run the company, or is he going to have someone else run the company for him? How does this affect the other companies that he owns, like Tesla? And so there's just so many unknowns, but the earnings announcement is definitely a known. And I think the fact that we have this outstanding bid kind of limits the range, if you will, of the underlying stock. So if we look at the Christmas tree butterfly, it wants the stock to stay within a range. And part of the reason why we're going to do a Christmas tree butterfly, which I really don't know why they call it a Christmas tree butterfly. There's no rhyme or reason. If anything, it looks like a Charlie Brown Christmas tree because it's a little slanted. But with that said, we're going to have a little bit different risk reward than I'm showing inside the options playbook. What you're doing is you're going to buy a strike, you're going to buy one call, and you're going to buy a wider long spread than the short spread of a standard butterfly. So that call is all the way down here, strike A. Skip strike B, if you will, depending on the width between the actual strikes in the real world. And then we're going to sell 3 of strike C and then buy 2 of strike D. Now, I know this is fancy and it's a little bit above and beyond what we usually talk about on the stock play of the day, but one of the things inside the Christmas tree is the fact that that 54.20 number is out there. So anything around that 54 level on the shorter term expirations is trading pretty cheap because the marketplace doesn't really think it's going to go above and beyond that. Now, anything can happen at any point in time. So this is one instance where we're truly crafting our strategy because we have some information on the marketplace. Now, this is always a very interactive show, and if you have any questions, please have that chat box open up. We're going to answer them live at the very end of the event. But I've been a little bit long-winded. I need to get into the actual strategy. So let's jump over to the Ally Invest option chains, and we have it up now. And inside the chains here, we're going to do the very short expiration. It's a $50 stock. It's down today. The announcement, the board approved it. The stock went down after the announcement, actually. That just shows some of the trials and tribulations. But we're going to have earnings on Thursday. Now, with that said, we do the stock play of the day on Tuesday. So I do want to emphasize that if this wasn't a paper trade and we weren't just trying to learn here, I would probably wait and look to do this trade on Wednesday, right? Just the day before earnings. See if the stock stays around this level. So that would be my approach. We're going to use the very short-term expiration. We're going to go to April 29th, which is this Friday, 3 days remaining. Scroll down here, and here's how we're going to set up our Christmas tree butterfly. You're going to notice that on the left-hand side, these are call sides inside the Ally Invest option chain. Make it very easy to do advanced strategies inside the Ally Invest option chains because we got little check boxes. So you notice that the B is a long ways away from the S here. That's the buy and the sell because we're making a very long spread part of our butterfly. And then we're not quite as far away here, but we're going to end up selling an extra call compared to a regular butterfly and then buying an extra protective put. Now, this is what I'm emphasizing. 54.20 is the number. We're going to do the 53s because obviously if 54.20 is the buyout price, usually the marketplace doesn't trade at that number because there's always some risk that the deal could get canceled. So we're going to do the 53, and here's the reason why. It's only 2 cents more. If we buy the 54, it's 6 cents. We can get more protection by buying the 53, and we only got to pay 8 cents for that option contract. So this is the reason why we're looking at a Christmas tree butterfly. Now, a little bit of skewing that's going to be involved, and we're going to get to that when we look at the profit and loss calculator. But the marketplace does know what we know, so it's a little, I'd like to get this trade done for around $3. The maximum you can make is the width of the long call spread. So the most this could trade for is $5, and that means that if it went out right at 50, the 45 strike call would be worth 5. These options would all expire worthless in theory, and you would make $5 on that trade. That's the maximum it could be. you're paying $3.26, so that's $326 plus commission on this trade if you were to put that trade on. So what we really want to do is the stock to just not move. We want it to just stay right where it's at, and hopefully, even if we get a little bit of a movement after earnings, that the stock might come back down and by Friday come back and settle in somewhere close to that 50 level. So a big number for us is the break even on the downside and on the upside. So if we're looking at the break even on the downside, we're looking at taking the net debit that we have to pay for the trade, which is 45, and we add in the $3.27 that we're paying for the trade. So 48.27 is really where we want that underlying stock to not go below. And it's going to happen quickly because they're announcing earnings on Thursday. Applied volatility is going to come out of the option contract. And the fact that we have this known bid, there's going to be a lot of activity in those options. So we're going to officially make this the paper trade right here. I'm going to click on the, I'm going to put the trade in the right rail. And I'll scroll down here and I'll read you the trade. So the most complex trade we've ever done on the stock play of the day, so it'll be fun to watch, and we'll be back Friday and we'll talk about it. And the announcement will happen, so we'll know what's going on. We're looking to buy to open one of the 45 strike call options, April 29th expiration this Friday. We're going to sell 3 of the 50 strike options, same expiration. And then we're going to buy 2 of the 53 strike options, also the same expiration. Well, the market's moved a little bit, so 330 right, well, we'll call it, let's say 330 just to make the math simple. They're going to be obviously very active option contracts. We want to fill somewhere near that midpoint, and if we can't, we'd want to lay down until the urge goes away. We're going to put on that trade. We got a little bit more risk than the net debit paid, and I'm going to highlight that in the options playbook just because of the way, because we kind of have a buffer. We kind of know the marketplace is going to struggle to get above 54.20. Now, anything can happen between now and then. A bidder could come in and say that they're willing to pay 60. We don't know, and that could, so what we don't know what we don't know, but right now, based off of the information that we have, we put our protection at 53, assuming that the stock will not go above 53 by that earnings report. If it does, we can lose the maximum on this trade. Okay, so that is in the right rail. Put your questions in the chat box if you have any questions. I'm going to go down and quickly pull up the profit and loss graph. And I may run over and just see if we got any questions yet. All right, we do. All right, we have 1 or 2 questions, so here we go. Let's talk a little bit about this and see if this generates some questions. So, very interesting. Now, remember what the options playbook looked like when we talked about the Christmas tree. Now, we've kind of skewed it a little bit in that we have from 45 to 50, that's only 5 points wide, but we have 6 points of risk because we have a 3-point wide short spread that we have, but we've done it twice. So our protection, and you can do this in any other type of ratio, as long as the ratio is 1 by 3 by 2, so you could do a 2 by 6 by 4, right? That would be considered 2 units, and that would be 2 butterflies. So we're giving you the profit and loss on 1 butterfly, 1 Christmas tree butterfly. But you notice here that we're paying around $3.30 for it, but we're adding in a little bit of risk. So if I highlight this, and I'm going to ask you to look at the profit and loss at expiration, it would be $428 if we paid $3.28 for that trade. We're adding 1 point of risk on this, but we feel fairly comfortable about it because the stock would have to trade right around the 54.20 level, which is the buyout price. So worst case scenario would be that the stock would land in, if the conditions stay the same, somewhere just above 53. That would be a bad thing. That's where our max loss would be. If it goes all the way down to this end, okay, we can't lose as much. We just lose the 320, right around here it says 328. So 328 plus commission. So that would be our worst case on that end. Here's where our break even is at. We're just above 48. On this end, it's just above 51, where we're breaking even at expiration. So we really hope that that stock will stay somewhere between 48 and 51. So interesting trade to say the least. And I'll try to answer a few questions. So let's run on over and look at the questions that we have. All right, Lance asks, could you share your thoughts about the bond market during these times? Is it time to consider getting in? Well, yeah, we're trying to catch the falling knife, right? I would like to see the VIX a little higher, and that would be just a general indicator. If I could see the VIX up around that 40 level or so, maybe that would be a sign of capitulation. I think we're close, but the marketplace is really scared about a 3/4 point move by the Fed in the short term. And maybe, if you want to be a little bit more conservative, wait for the next Fed meeting. But obviously, there's been some real strong movement on the downside. So trying to pick the very bottom is really hard to do. So if you're looking to invest and you think this may be the spot, then put a little bit of capital in and then keep a little bit on the side. So whenever I'm trying to catch a falling knife, I very rarely say, here's all my capital, let's go on out and grab that knife as hard as we can and try to hold on to it, and hopefully we won't cut ourselves too bad. So I would prefer, if I have some capital, if you're lucky enough that you got out and you have some capital on the side, to put it in increments. Maybe think about buying a little bit here, buying a little bit after the next meeting. Obviously, a big unknown is what's going on in Ukraine and the geopolitical concerns that we have. So you would probably like to be in before we can kind of get a resolution on that, and hopefully we get a resolution very, very soon. It's horrible what's happening over in Ukraine. All right, so that's my thoughts, and there's no way that I can pick the bottom. Nor do I want to try. And on top of it, that's not what the show is about. This is about learning about option trading. Okay, and Clinton has a couple of questions here. When you enter a multi-leg strategy, is the trade all or none? All legs or none? Yes, it is. Now, it's the unit. So this is by far the most complex strategy that I think we've done on the stock play of the day. And it's a ratio butterfly. That's the non-technical term, or the scientific term would be that it's a ratio butterfly. So you have a unit that trades, and this is a really good question. So the unit is the smallest denominator, the ratio. So 1 by 3 by 2 is 1 unit. That's the smallest unit that can fill. If you do a 2 by 6 by 4, in theory, 2 units could fill. Now, very rarely, I shouldn't be that dramatic about it, but it's not that often that if you did 2 units that both trades wouldn't fill. That means that the marketplace decided they just want to take one of those and they don't want to take the other trade. But it's possible, right? So it's not necessarily an all or none, but you got to think about each unit and how that works. But great question, by the way, Clint. Are there tutorial videos available for the features and functionality of the Ally trading platform? There are some, and a lot of them come from the fact that we did a customer service show. We have a few help videos. We have a help video that's in the options chain. Clinton, if you want to go out and send me an email, I'll try to share some of those with you. My email is theoptionsguy@invest.ally.com. I've seen you in the chat box before. I know this isn't your first time being here. So my email, once again, is theoptionsguy@invest.ally.com. All right. Well, that's all that we have for the show today. This is a fun trade. I was excited to talk about it. Everybody's talking about Twitter, so we had to come up with something to try to address the fact that we have a buyout that occurred just before an earnings announcement. Please click subscribe, ring the bell, and we'll see you this Friday for the Stock Play of the Day Overtime. Thanks for coming, everyone.